So I'm introducing Regency Mines today, and I'm here with my colleague Scott Kynes, who's sitting there in the white shirt and jacket. And he can also answer questions. Here's a conventional disclaimer, which when we put this up online, you'll be able to read, but I'm not going to pause long enough for you to read the whole thing now. It just says the conventional things. Some of these are forward-looking statements. We use our best efforts to make them accurate, but cannot guarantee they are. The company overview. We're looking for cash-generative investments. We have always tried to create value at different phases of the commodity cycle and to identify and develop different projects, because when we first listed Regency, the aim was to be a transactional company, a kind of mining finance company, not just an explorer. So in our early days, we floated off Red Rock. We helped another couple of companies, Thor Mining and Churchill Mining, get listed on AIM and also Greatland Gold. But we acted as a generator of ideas as well. As time went by, we were doing more exploration, had less time for these other things, but we've always been involved in some transactions, and now we're moving back that way a little because, quite simply, we want to generate cash. And the exploration model was never good at generating cash in other than bull markets where you could go back to the market and raise money again. But the exploration model on AIM is not working well at the moment because we're in a commodity downturn. That means that if you don't have cash flow, you're having to rely on either asset sales in what is a buyer's market, not a seller's, meaning that it's impossible to force the pace or the outcome of a sale negotiation, or you have to generate cash from operations. Otherwise, you're dependent wholly on the market. And the time when you may need to raise cash could be a time when the market is low or the appetite of investors isn't there. And you may find the only investors interested are the typical broker retail clients who tend to throw the stock out again. Now, we have had suffered from that, like other companies, a little on the way down because we had a certain level of debt incurred in exploring one of our key assets, which was the nickel and cobalt in Papua New Guinea, where in addition our partner there, towards the end of the exploration, fell short in meeting their share of costs, so we had to meet theirs as well. And winding down that debt exposure was very essential with the way the market was going the last 3 or 4 years, but put an additional burden on our funding. So what we have now done is we have reduced our operating costs to the bare minimum, and we are therefore controlling our cash outflows, and we'll continue to control them at a very low level. I mean, we reduced in successive years, but we've reduced this year, in the last few months to the next few months, by well over 50% all our costs. We really can't bring it any lower. So we've reduced outflows and we'll keep them low. At the same time, we want to generate inflows from cash-generative operations and at the same time work our assets to sell some of our investments to redeploy in the business. So oil and gas investments and development is one area that we're focused in. And we have a West Virginia shallow oil project, which we were planning to start this year, but with the fall in the oil price, we're waiting till operating costs come down to match the lower pace of activity in the market before starting that program. We also have a cooperation agreement with American Resources that has extremely good technology and has one project, North Francitas in Texas, which is shallow oil. The oil wells are already there with good pressure. They can produce the oil, but because there's a very, very high water cut in that project, It depends on disposing of the salt water in order to produce. And they have the salt water wells available, which means these can be brought back into production with no drilling whatever. Mineral exploration, that portfolio, agro-minerals in Sudan, rare earths in Greenland, nickel in Papua New Guinea. We're not proposing further exploration there in the near future because we want to concentrate on the cash flow side of the business, but we're going to try and retain our interest in those assets because some of them, in particular Greenland, have huge long-term value and are not that far off viable pricing and cost. Nickel prices come down so far, we probably have to wait a bit there. We have, as you see, investments here also. Now, if you look at this North Franciscus project I mentioned, here's a quick summary of what American Resources do, and they have a good pedigree. They've worked for big companies. They have a lot of experience in drilling and oil services, applying technology to improving recoveries from oil fields. And that, of course, is the cheapest way to produce oil. And with the oil price having come down, with some possibility it'll come down further, you really want your oil production to be very low cost. So we're focused on that with them. And the initial project is this North Franciscus project, which is one where we would be taking a 50% working interest, and it consists of 2 existing production wells and 2 identified saltwater disposal wells that we and our partners there can acquire. Our cost would be $430,000, and that would bring us back into production. So as you see, really no geological risk, very, very little completion risk, and so with a good internal rate of return and net present value, that represents an attractive investment proposition, because you have the returns, but you have very low risk. And given where we're starting from at this point in the market, that's what we have to look for, particularly in our initial projects. We can't even afford one thing to go wrong. So at the moment, our partners are trying to line up some of the leases on this project, and we hope they'll succeed in that. But they have other projects available as well, which we can look at and will look at if this one goes a bit slow, and which would have much the same effect. So as you see, initial 50 to 80 barrels a day, and fairly steady output over the years, very low cost of production, high internal rate of return, and a 15-month payback on conservative assumptions. Now, we have seen quicker paybacks, we have seen higher internal rates of return, but we haven't seen these associated with no geological risk. Agro-minerals in Sudan, we've done some good work there. There is some possible further work that can be done looking at potash on the coast, which is near Port Sudan, so a much better location than other projects in the south in Eritrea, which is a much inferior political environment anyway. But this is a long-term asset, and we're dealing at the moment with short-term market conditions. So these are not a priority for spending, in fact the opposite just now. The Motzfeldt multi-element project is something that we got opportunistically, and as I say, we have a history of trying to do opportunistic deals to make money out of buying or selling or putting people together. We're going to do a lot more of that to generate cash flow and profit. But this was one. We picked Motzfeldt up when other people dropped it at really no cost. It contains the world's largest known resource of tantalum and niobium, and is only partly explored. And in fact, it is possible from where this tantalum is to get it out to sea, because it's in the extreme south of Greenland. So with the demand for tantalum in electronics and in other new uses growing, this tantalum resource is one of the world's most attractive. But one needs to do some more exploration there in time in order to find the best location for potential production facility. And that is something that requires greater resources than we possess, and we'd suggest a lot of capital. So we're looking for a major partner to proceed with that. And historically, people have paid many millions of dollars for this asset, and we've got it for nothing. And we're sure we can work it to make money out of it, either now or in a year or in 2 years. We've done very little exploration on it so far, but large parts of the resource have further potential for rare earths, niobium, tantalum, and other metals. And so this huge resource, as we say, we believe the world's biggest tantalum, is only a starting point there. And this shows the Motzfeldt project in comparison with other ones. So it's extraordinary to find a very small company like ours actually controlling this project at nil cost and with very low maintenance cost. The nickel interests, we did a lot of work there. We proved up one of the world's largest nickel laterite deposits, nickel cobalt, that's in Papua New Guinea. But the nickel price, just as it was the first to go up at the beginning of the mining boom in 2003, has been the first to go down, and in fact is now down at its pre-mining boom level. In other words, the long-term trend that lasted for decades up to 2003, when supply and demand were in much better balance, has been re-established in nickel, whereas, for example, copper is still 50% higher. Other metals are 50% higher. So there's been a huge adjustment down, yet nickel has one of the best outlooks of metals, in that it's difficult to find new sources of supply as Sudbury gets fairly exhausted, and 65% of nickel goes into stainless steel, and as the world industrializes and develops, stainless steel usage really increases. So in the center of some of the largest populations in the world, in Asia, this Papua New Guinea asset, one of the largest, as we say, and only partially explored, is a key strategic asset, but there's no denying the costs and selling prices in the market for nickel mean that we cannot advance this at the moment because it's unfundable at current metal prices. But we've seen how quickly the nickel market can turn, and we're convinced that if we hold on to this and maintain it, in another 2 or 3 years, we will find that the nickel price will suddenly go up again, and people will have interest in this asset and in our direct nickel technology asset holding, which is a new cost-effective way of treating lateritic nickel that will reduce the cost of a project to the lowest 25% of costs in the industry as a producer. We have another application which might be suitable for direct shipping or in Papua New Guinea, but again, we're not proceeding that very aggressively. Our corporate investments, we have the West Virginia oil project, which I've described briefly to you, and we're sitting, waiting there, because this is so easy to produce, but so cost sensitive that we really want to get those drilling costs down before we do anything there. We have a stake in Red Rock Resources, which I think is on the turn and has very good prospects from this point. RAM Resources, where we've been selling our holding, and as we've done that, this is an asset that had minimal cost, that as an example of our deal-making capabilities, we sold into RAM something that initially cost us $5,000 or $20,000. We spent a little bit more on it over time, and so far we've got nearly $1 million out of selling shares. We have an interest convertible into $200,000 of RAM shares as well, plus we have a royalty. And so this will be an ongoing source of funding. We also, incidentally, have, though it's not mentioned there, an interest in a graphite project, a Halberts project in Australia, where we had some tenements adjacent to a historic producing mine. And this historic producing mine was the best graphite producer in Australia, one of the best in the world, producing high quality flake graphite. At a time when people are getting very excited about graphite, there is a very good management that's developed other mines that wants to bring that into production, and we managed to do a transaction with them whereby our ground was given up in exchange for us having an interest in that future mine. And this is a man who's developed mines in Papua New Guinea, in Australia and in South Africa, and who is determined to do that here. So we see this, like RAM, like Alba Minerals, which we had for 10 years a holding in, and over the last year or two we got involved in oil drilling, introduced them to the oil drilling at Horse Hill, and then sold out and got out at a very good price. The last part just recently. So as with Alba, as with RAM Resources, so in future we see in the graphite, we're going to be able to work these investments to generate money from them when they go up and become popular. And at the same time, our portfolio of exploration assets we're going to work. But Regency, in addition to all of that, has receivables that we fully expect to realize and to be able to get cash from in the comparatively near future of about half its market capitalization or more. So in terms of asset backing, Regency is in a very strong position. In terms of the transactional skills of Scott and myself, our ability to do deals, our flexibility, we believe that from here there's only one way to go, which is up, because we've got our costs tightened, buttoned right down, and we've got all the distractions removed from our office. There's Scott, myself, and Rasa running this company and one other, and we're totally focused on the transactional side of things and bringing in revenues so that our revenues exceed our much reduced costs. That'll take us a long way away from the exploration model, even before we start to make one-off profits from broking deals. So that concludes my presentation, and technically we have two minutes or just over for any questions. So I'm going to use that 2 minutes and invite any questions. Yes. We've been asked that. I'm glad this was the question of, because the price is so low, would we consider share consolidation? The answer is we exactly intend that. And the reason that we're doing it is because of requests from shareholders like yourself. So there are a few people who go into chat rooms and say, why are you consolidating? It's terrible. But we say there are a whole lot of people who either speak to us direct or write to us or telephone us who are very sensible and tend to be better qualified than the people in the chat rooms who are telling us we should consolidate, including professional advisors. And the reason is that if you go onto the AIM stock price page, or you go onto Bloomberg, or you go onto Yahoo, you can't see the price because there's one decimal place too many needed. So you can get, say, something saying the price is up 10% or down 15%, but you look at the price and it looks unchanged. And that's hopeless, because one thing people want when they deal in a stock is they want price transparency. They want to be able to see whether the price is moving and what it actually is. So the sole reason for this consolidation we're planning is to bring that stock back to the half P plus level so that people can actually follow what the price is doing and invest intelligently and not get confused by too many zeros. So we're deeply conscious of our responsibility running this company for the price having gone down to a level where there are these zeros. But starting from here, what we're doing is the right thing to do, and we think it will really help people trade the stock, and as long as it's combined with good news and positive developments, it can lead to a new era for the company. Thank you. I'm now being signaled that we have 2 seconds left, and so I'm going to finish. Thank you very much.